short of absolute calamity and disaster, I think that owning parts of the global economy, owning equity in companies around the world is going to be the long-term driver of wealth.
You were a traveling salesman selling investments to investment advisors.
Yes. And I discovered this entire world that I did not know existed until I was there, which is called wholesaling. And my job every day was to go meet advisors at brand name banks that we've all heard of, go interview them about their clients, about their portfolio management style. I visited thousands of advisors over these, 14 years as a wholesaler. And um, I just cannot express to you how many cases were situations where some advisors like, here's my investment model that I use for my clients, and it has these 20 different holdings, which is way overkill, and 18 of them were like the same thing.
From your insider view of understanding your investment products that you were representing, your competitors' investment products, what did you learn about these investment funds that could help the everyday investor to make better decisions? I'm really excited for this conversation because you have what I would consider an insider's view into finance and a lot of background that is really relevant for people that are trying to make good financial decisions in their lives. Where I'd love to start is by hearing a little bit more about your career progression. How did you first get started building wealth and what did that look like for you?
I didn't know necessarily I wanted to go into the financial services world. My undergraduate degree was in economics, and my dad and my brother had both been in the financial industry. My dad used to manage financial advisors. My brother manages assets for a large institution. So I'd been around it my whole life. One of the stories I like to tell is that growing up, I was born in 81. I'm 44 years old. In the 80s, before every household had a computer like in the house, we actually had a computer monitor in our living room that tracked world currencies 24 hours a day, because my dad was a currency trader for a bank here in Houston. And so he had to get up in the middle of the night every night and go check and see what's happening with Asian currencies, for example. Was there some kind of blow up or anything happening? And so, like, from as long as I can remember, I was introduced to financial concepts and investing and things like that. And so it, piqued my curiosity. But coming out of school, I wasn't so sure of exactly what path I was going to take, but I wound up landing a job with an asset managers being the ones that package stocks and bonds into funds that we can all invest in, like ETFs and mutual funds and things. I got an entry level job. I didn't have any of my security licenses or anything, and I was essentially going to be an assistant to some higher ups, and learned about the pathway and the career there, which was like a really, really cool thing that I'll talk about here in a second. And just started obtaining my licenses and worked my way up through their system and started answering inbound calls from financial advisors who needed questions answered or help with various things. And I discovered this entire world that I did not know existed until I was there, which is called wholesaling. And what wholesaling is, the asset managers, they're the ones like, let's take Vanguard or BlackRock iShares or State Street Spiders, kind of these, maybe some familiar, if to the extent people know what different fund families are. Those are some popular large ones. They have representatives that work for them that will go meet with financial advisors and tout their investment portfolios to convince the financial advisors to use their investment products with their clients. So the representatives that are out there meeting with the advisors live in a given territory. So, like, for example, my company was headquartered in California, but I was based in Houston, and I was assigned to a territory which varied anywhere between 3 states to like 10 states in geography. And my job every day was to go meet advisors at brand name banks that we've all heard of, go interview them about their clients, about their portfolio management style. And as an asset manager, we might have a list of 100 funds that all do different things, or all have different objectives, and they're different tools in the toolbox. And my role was to figure out what where are the pain points for this advisor. An advisor might say, well, here's how I manage client money, and I'm really unhappy with their large cap stock fund. And I would say, great. we've got an awesome large cap stock fund. Here's all the reasons it's wonderful. And here are all the reasons that it could be potentially a better tool for you and for your clients as compared to the existing fund you're using. And it really required me to not only know how our investments were structured inside and out, but also our competitors, because you typically run into the same competitors frequently. And at the time when I first got out into the field, so to speak, and meeting directly with these advisors, I was 26 years old, and the advisors I'm meeting with were all like 60, 70 seasoned people, and I had a baby face, didn't have the beard yet. It was kind of like you really, really, you either had to do a lot of whining and dining, which I don't do. I don't play golf. I'm not a schmoozer. Or you had to like really be smart and know your stuff. And not to say I was like overly smart, but that's the only way I could go. The thing I could do was like be as smart about our investments and how they work and really vibe, so to speak, with those advisors that care about that kind of thing. And it just so happened that my first year out in the field doing this was 2008. So the whole global economy is collapsing, the stock market is collapsing, and all of a sudden, whining and dining advisors no longer sold products. It no longer helped the people in the field. You had to really know your stuff. You had to be able to talk to the advisors about why something is performing the way it is and this and that. But it was just a really cool gig. Like you were in a different city every week and out and about, going to different offices, things like that. So that's how I got started. And as a traveling salesperson, which is essentially what I was, um, you know, uh, that's how I started building wealth. It was we were rewarded for the lack of social life and for all of our responsibility. We were the face of the company for large swaths of the country. So that's how I started out.
Okay, so you were a traveling salesman selling investments to investment advisors.
Yes, and just for the avoidance of confusion, no advisor ever like filled out like I want to buy XYZ fund from Matt's fund family. What would happen is an advisor might say, "You know what? I really like the strategy of your large company investment fund. I'm going to recommend to my clients that they invest in it." And when client dollars go into that fund, it can be tracked. Like you're purchasing that fund from the asset manager. So the asset manager knows, oh, we had $1 million go into our large company stock fund from this advisor at this office in Houston, Texas. Matt gets credit for that.
Yeah, it is very similar to what my dad does for work. He's a B2B insurance salesman where basically he's meeting with other businesses or other insurance brokers, convincing them to represent his company's products when they're presenting recommendations to their clients. So,
Yep.
exact same type of play there.
Yeah, I use the analogy of pharmaceutical wholesaling. Like you go to your doctor and they say, "Hey, you need a cholesterol drug." Well, Pfizer makes one, Eli Lilly makes one, probably a bunch of others do. And sure enough, Pfizer and Eli Lilly both have their sales reps going to meet the doctors to show them the studies and say, "My cholesterol drug is better than their cholesterol drug, and you should use mine." And it's a very similar concept.
There's a lot of people when they first get started investing, it can be very overwhelming because you're trying to pick an investment and there's 1,000 different funds to choose from. They all seem somewhat similar. And if you don't know the nuances, it's hard to know how to create your own investment portfolio. From your insider view of understanding your investment products that you are representing, your competitors' investment products, what did you learn about these investment funds that could help the everyday investor to make better decisions?
I learned so much that I will try and keep this concise. I'm going to start with the most simple answer, which is you're right that they all do seem very similar. And for 99% of investors out there, they're all similar. You're not going to devote the time and resources to try to be effective in like picking which one is better than the other. So what I recommend everybody do, and I even do this with my own clients, is focus on owning broad diversified portfolios, whether that be in an index ETF or an index based mutual fund, and keep costs low. I personally like ETFs, that's exchange traded funds. I worked 6 years for a mutual fund company and then 8 years for an ETF company. I'm relatively, balanced on the two. And I think that the ETF structure is just a more modern, better overall structure for most people's needs. It's not for everybody, but for most people. And so you just go and you find low cost ETFs to get access to the types of investments you want. And you could keep it ultra simple and go get like a target date fund or a target risk fund. You could say, I'm a conservative investor or I'm a growth investor and I'm going to go buy a single package fund that owns a bunch of underlying stuff, like a big bag of chips. I'm gonna go just buy like a you know mixed bag of chips or whatever, and
The
own it
checks
all.
mix.
Yeah, yeah, exactly. Like a variety pack or whatever. And some days you're gonna want Lay's, and some days you're gonna want Doritos or whatever. But you've got this variety pack, and you just buy it as one single thing, set it, forget it. Especially if it's a target date fund, you can do that. And from there, you can make it more and more complex. And there's just a certain point in which like there's diminishing reward to making it more complex. In my own world, I typically use ETFs to get different asset classes like large US stocks or international stocks or US bonds. I'll get big kind of groups like that and then put them together in a portfolio for people. And I'm mostly focused on getting broad exposure through consistent index companies. We can talk about that in a second if you want, and just keeping the cost low. Like a Vanguard S&P 500 ETF is not going to be that meaningfully different from a State Street Spider S&P 500 ETF. They're generally going to try and do the same thing.
Yeah, it sounds like we actually have very similar investing strategies. I came to a lot of the same conclusions that you did, which is if I can have a couple groups of broadly diversified ETFs, I'm going to reduce my sequence of returns risk and really capture the upside that I'm looking for while having it be very passive for me. And I'm also a Vanguard ETF proponent. One
Yep.
that I love is called VT, and it's almost like the biggest
Yeah.
single
Total
package
market.
you can get.
Yep.
Yeah, it's total market, US and foreign companies. And that's why my equities fund. And then I have BND, which is the total US bond market for both corporate and government bonds. And it's like, okay, between those two funds, I'm pretty much capturing a significant portion of what I need to in my investment portfolio. And it's incredibly simple for me to manage.
Yeah, that's great. Yeah. And I think that can work for the vast majority of people. The only difference being is like what proportion do they want to own VT and what proportion do they want to own BND, just based on risk.
Or if you want to get like maybe a little more nuanced, you could purchase VTI, which is the US stock market, and VXUS. And now you're splitting the US and foreign companies in half, and you can monitor those separately. But it's really like you start with a simple foundation. And then if you want to add a little bit of complexity along the way, it's very easy to split those and to do so.
Yeah, it's funny you mentioned the Vanguard in particular. I actually use one of Vanguard's decks to illustrate a concept to both clients and advisors. I didn't mention this, but I also have a side business. I don't even advertise it anymore, but there's a side business where advisors can still hire me on an hourly basis for like investment consulting stuff because of my background. And I usually start with a Vanguard deck that says there's a single page that says, okay, Vanguard has a family of investment funds that track S&P indexes, and they have a family of funds that track CRSP indexes, and they have a family of funds that track Russell indexes. And where people can often slip up when they go anywhere beyond VT and BND that you talked about, when they start trying to spice things in, a lot of times what happens is they might take VT and add VTI on top of it. And
Yep.
now they've got this massive overlap. All the US stocks from VTI are already in VT. And so they're doubling up on this stuff by accident. And it's kind of like an illusion of diversification in a lot of ways. And the Vanguard deck does a really good job of illustrating for you, okay, if you're going to branch out from that super simple VT BND portfolio, You want the things to fit together like puzzle pieces. You want to minimize overlap, right? You want them to lean right up against each other, minimize overlap, minimize gaps, and just have them fit together nicely like a puzzle. And so that's why I try and stick with one underlying index. I care much less about the brand, whether it's Vanguard or iShares or Spiders or whoever. I care a lot more about the index that is the like chassis, like the engine of the car, so to speak. In my world, I use S&P. So Vanguard has a family of S&P indexes. And as long as I'm combining S&P's large company index with the mid company index, with the small company index, whatever, then they're going to fit together nicely. Where things start going wrong is if somebody's just like looking at performance returns and they're like, oh, well, this one looks good and that one looks good. And they combine like an S&P based large company fund with a Russell small company fund, and now they don't align correctly and there may be overlap, there may be gaps. It's like it can it can create problems in the portfolio that you're not aware of, and you may never become aware of them, but it will impact performance, and volatility.
Yeah. Oh man, I'm really nerding out on this because I love this. But yeah, I see that all the time where, like if you buy the S&P 500 index fund and a Russell 1000 index fund, those are going to overlap and you're not getting as much diversification as you think you are. So back when I was in college, I was interviewing with management consulting firms. So I was doing some case prep, and there's this principle that they teach. It's MECE is the acronym, MECE, and it stands for mutually exclusive and collectively exhaustive. What that means is if you're trying to solve a problem, you want to use a framework where you're isolating things that are exclusive from each other, meaning they don't overlap, and then also collectively exhaustive, meaning that you're not having those gaps in your portfolio that you're talking about, where maybe you have international stocks and you have large cap US stocks, but you're completely missing out on all of the small cap US stocks. And that would be the piece you want to add.
Yeah, I just can't tell you. I mean, I visited thousands of advisors over these 14 years as a wholesaler, and um I just cannot express to you how many cases were situations where some advisors like, here's my investment model that I use for my clients, and it has these 20 different holdings, which is way overkill,
Yeah.
and 18 of them were like the same thing, with like very little difference between them. They had different titles, and to this day, I'll hear people say, "Well, it's still diversified. It's still diversification." And the analogy I use is like, think I'm in Texas. I think about football. You have a when you field your 11 players on the field, you have like one quarterback, and maybe you have two tackles, two guards, a center, like kind of the standard stuff that goes in football. But you're not fielding two teams worth of like quarterbacks. Like you don't want three quarterbacks on the field all calling different plays. You don't want to triple up on the amount of wide receivers you're supposed to have. Like, that's not diversification. That's like stupid chaos, and not everybody's going to be bumping into each other and doing different things, and it doesn't work. Like, you need to have the positions filled with the players you want, and they each need to be doing their own thing that they're supposed to be doing. But like, you don't want two of them running routes and bumping into each other, that are not coordinated with each other, is the way I'd say it. That's not diversification. That's just dumb.
Yeah. So I think this is a really important point to address here. Why wouldn't you just chase the highest possible returns? Like, why is diversification important in the first place? Why do you need to assemble these different pieces of your investment portfolio?
I think you're hitting on one of the biggest misconceptions I ever see out there, which is often diversification is sold as being additive to returns, and that's not the way it should be sold or described. Proper diversification is going to reduce upside return. Like, if what we've experienced over the last 15, almost 20 years is US large cap stocks have mostly pummeled every other asset class, international stocks, whatever we want to look at, US small cap stocks, that kind of stuff. If you had been invested in just the S&P 500 to get mostly large, a little bit of mid-size stocks, you would have done way better than having a diversified portfolio. So diversifying doesn't equal better returns necessarily. But what it does is it allows you to stay invested for the long term that you need to be to actually achieve the returns. Because let's say you had only S&P 500 stocks and you went through the tariff tantrum in April of 2025 where Liberation Day announcement happened, stocks went down, I don't know what they went down, 10% plus, over the course of a month. Or during the pandemic when stocks were down 30 plus percent over the course of a month. So many people in real time cannot easily see the benefit of holding on. To them, it feels like the world is ending. Everything's in a collapse. This is 2008 all over again. This is the Great Depression all over again. This is Armageddon, and it's time to get out. And if you are diversified and maybe you see that the stock market's down 30 some odd percent, but your portfolio is down 15 or 20, you're not happy. You're not like, oh, this is awesome, but you're less likely to just get out and go to cash. You're more likely to ride through it. And so for people that can just like get on the roller coaster and hold on and be in the S&P 500 for 80 years, more power to you. I think you'll probably do really well if you can do that. But the vast majority of people can't when in real life. It's very easy to look back now and be like, oh, pandemic. Yeah, I would have been buying the whole time. When you're in the middle of it, you probably wouldn't have been. And so people need diversification to try to make the low bad times less stressful, less hard, and allow you to stay invested for longer. Because if you stay invested at a lower return, you're going to do better than if you don't stay invested when things go wrong and you just start earning cash returns for extended periods of time.
Yeah. Oh man, I agree with you wholeheartedly here that diversification, this is how I think about my personal investing philosophy. Diversification makes my investments more predictable. If I could get, if maybe I'm in a more concentrated position, I could get 20%, negative 10%, 0%, 5%, 35% over the years. Or if I can diversify and get somewhere between 6 and 10% every year, because there's always a winner and there's always a loser, and it's just steadily increasing over time, that's going to be very predictable and it's going to be very easy for me to continue investing and continue dollar cost averaging into that. Now, there's going to be someone listening to this that says, I've got the stomach for it. I can watch the big drops and ride through them. Why on earth would I diversify? And I think the answer to that, at least for me personally, I'm curious to hear your answer as well. The answer for me is that when I think of my retirement investments in the stock markets, in my Roth IRA, my 401k, et cetera, I want those to be predictable and I want them to grow continuously. And I want them to be passive. I don't want to have to be monitoring them all the time. However, I also want to capture the upside of making concentrated risks. So I almost think of it as a barbell strategy for myself, where my retirement investments are relatively passive, invested in index funds, but then I'm making concentrated bets in my business where I feel like I have the most upside and the highest leverage. That's where I'm willing to take the risk and see if I can generate a higher return for myself.
Yeah, I think that's a really good point. And I have to point it out to my clients somewhat frequently. Like it's hard for most people to just hear the plain doctor's advice of like, look, just eat right and exercise. Like that's 85% of the battle. All these trends and fads and diets and magic pills and everything you hear about, like the reality is like the simple solution is often the best. Now, to more directly answer your question, I kind of have this philosophy after my nearly 20 years of being in this industry that if someone says, like, I've got the stomach for it, okay, like, go for it. I don't care. I truly do believe that stocks, owning equity in the global economy, will be the long term generator of wealth for me and my family for decades to come. And if I'm wrong about that, it means like the asteroid has hit Earth or the US Treasury has defaulted on Treasury bonds. I mean, a, 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 a a nuclear war has started. I mean, short of absolute calamity and disaster, I think that owning parts of the global economy, owning equity in companies around the world is going to be the long term driver of wealth. I think it'll come with like a whole lot of really scary moments along the way. But if you are this hypothetical person telling me you can handle those and you can just keep putting money in week after week, buying when, despite whatever the headlines are, go for it. That's totally cool. And how you do that, I don't care that much. Like you're gonna be rich no matter what. If you want to do it in VT, which is like global stocks, great. If you want to do it in VTI for US stocks, because you're just like US biased, great, go for it. That's cool. I don't really have a big problem with that. And for people like you and I that are business owners, yeah, we have a bunch of concentrated risk in our business. Almost everybody has some kind of concentrated risk in their career. Um, I think the other big long term driver of wealth that I probably should have mentioned, you know, is your income and your career, right? So with my attorney clients, maybe they're partners at their law firms, like they have private equity. Like that's
Yeah.
private equity investment. So I don't have a problem with it. I have enough time in this seat to know that even the most bold people get really scared sometimes and they will make bad decisions, bad timing decisions. I have people that have come to me that said, "Hey, I got out during the pandemic and my 401k I went and sold and went to cash in the pandemic and I thought I got back in, but I guess I never hit the button. I guess I never clicked the buy button."
No.
And I've been out of the stock market, for the last 3 years. I have people that have come to me who have been putting money dutifully in an IRA or a backdoor Roth IRA for years, and they thought they were investing, but had just been sitting there in cash the whole time because they didn't know they had to actually like go buy something. So it's like, if you can get the fundamentals right and you can stomach it, man, go for it. Go for it. I don't do it for myself. I don't do it for my family. I think I personally have an extraordinarily high risk tolerance is what I'm told by my spouse, but she doesn't. And so our families, we're not 100% stocks. And we think beyond just the investment portfolio anyway, in terms of your entire, or what should I say, in terms of your entire investment portfolio, we're not just thinking about like the accounts held at Charles Schwab or wherever. There are other investments you make that aren't just funds, whether it's real estate or investments in your children or your career or whatever, that kind of stuff. But somebody wants to go guns blazing, be a cowboy, go for it. I do think stocks are the long term drivers of returns.
Yeah. I want to go there. You were talking about how you have a high risk tolerance. I want to go there for a second and talk about your personal investments. What's the breakdown between different types of investments that you have?
The investment portfolio breakdown is about 70% stocks and 30% bonds. That doesn't include, like, I don't include like a cash liquidity fund within that. But yeah, that's how it's invested. And I think it strikes the right balance between, like my age, I'm 44, my wife's younger. My wife is very conservative when it comes to investing. It's not that she's not uneducated on it. Her degree is in finance and she's an attorney. She's a smart person. But she just doesn't like all the volatility and stuff. She would rather have more predictability, less anxiety over things. And I totally respect that. I think that's fine. And 70%, in my opinion, is a healthy risk allocation. I have very few clients that have 90% or more in stocks. Most of my clients are in the 70 to 80% range. Most of my clients are age 40 ish on average. I've got 40 plus households. So that's where we are. That's where the long-term allocation is. I do think that we will retain that sort of aggressive posture maybe longer than a life cycle fund would. Like a traditional life cycle fund that's going to get more conservative as you approach retirement is probably going to start becoming more conservative earlier than I would. And it would probably go down to a lower stock allocation than I would. And the other thing I do is once you enter retirement, I actually start increasing the equity allocation back up again because if you think like, here's the end of my life and I'm approaching that, well, my time horizon's getting shorter and shorter and shorter. As long as I have enough money, I can afford to actually get more aggressive because these assets become legacy assets for the next generation or charities or causes or whatever it is you want to do with the money. And so it reverts from being a portfolio of cash that needs to fund my life, and it starts to evolve into a portfolio of cash that I want to last for another 100 years or whatever it may be.
Oh man, I I'm really glad you mentioned that. I feel like we have very similar investing philosophies, and my biggest beef that I have with target date funds is if you look at the glide path. So for anyone that's not familiar, a target date fund is basically put your money in this one fund and we'll make the investing decisions for you, and we'll make it more conservative over time so that you're not over leveraged or have too much risk as you get closer to retirement. The problem is the glide path, which is if you have a target date fund for, let's say, 2045, then once it hits that date, a lot of times it'll trigger a glide path where it's like assuming that you're now retired, and it becomes incredibly conservative. Some of these target date funds have a glide path where eventually you have 20% stocks in your portfolio and 80% bonds and money market funds and cash. And I just never see myself being that conservative with my investments. So I usually try and encourage people. It's like if you're willing to learn a little bit about it and you're willing to make some of the decisions along the way, you can set up a very successful portfolio with a couple index funds or ETFs that allows you to control more of that risk level much more successfully than you'd be able to do with just a single target date fund. If you're listening to this episode and thinking that it's about time to revisit your investing strategy, then you should check out the Investor Blueprint. The Investor Blueprint is an online video course I created that walks you exactly through how to build your own investing strategy from the ground up. It's super comprehensive. There's over 60 videos that you can dive into. And I even have an entire section about how to shift from target date funds into choosing your own index funds. So if you like this episode, you would love the Investor Blueprint. There's a link in the description below. Just click on that, it'll take you right to my website. And if you use the code podcast at checkout, you'll get 25% off. So go check it out in the description below.
I totally agree with that. I think my I agree with everything you said. My addition to it would be, if you a target date fund, for all of its flaws, is still better than not investing.
That's
And
true.
so if you're somebody who's not going to learn about it, who's not going to take the action or the initiative or whatever, like, there is no perfect strategy and there is no silver bullet. Like, target date fund has flaws, but like, at least do that.
Yeah, it's the 0 to 1. It's like
Yes.
if you have a company that offers a 401k match and you're not currently signed up for your 401k, it's like, "Oh my goodness, dude. Go sign up for the 401k during open enrollment and just choose the simplest target date fund so that you're at least in the market and you're at least capturing that upside
Yeah,
while you figure out what you want to do with it long term."
exactly. Absolutely.
Well, Matt, thank you so much for joining me today. It's been such a fun conversation. I love investing, and I think we've covered some really important points here. If there's one piece of advice you could leave with people who have listened to this episode, what would it be?
I didn't think about that in advance. I would say my one piece of advice would be to don't let the clutter and media that come around investing and broader financial planning, don't let it intimidate you. This stuff is not as complicated as people make it. They make it complicated because they need to sell you something and convince you to make a change or whatever. Just take a first step, like you said, enroll in the company's 401k, at least up to where the company's going to match, and just select a target date fund that aligns with when you think you're going to want to start using the money. Take that first step and you can do 80%, 90% of everything that's necessary with a few small steps. Like, you can really dramatically improve your financial security with just a few basic steps. It doesn't have to be complex.
Awesome. Great advice there. And for anyone who's interested in learning more about you, where can they find you?
But yeah, our website is concertplanning.com. concert.com. The company is Concert Financial Planning. That's where you can find our blogs, our podcasts, our contact. You can find everything you need there.
Awesome. Thanks so much, Matt. It's been a pleasure.
Thank you. You too.
Thanks so much for watching, and don't forget to subscribe to the show for more episodes like this one.